Hello everyone, my name is Siddharth Srivastava and I'm head of ETF Products at Mirae AMC. And today I'm here to talk about some of the nuances of passive investing and ETF in particular. So before I talk about the investment vehicles, let's first understand what is passive investments and why passive products. So as markets become more efficient informationally, it becomes very difficult for active fund managers running the mutual fund schemes to outperform the underlying benchmark or the market and do that on a consistent basis. And this has already happened and happening in developed markets like US. And this is now we are also observing in India, where there are very few mutual funds, especially in the large cap categories, which are outperforming the underlying benchmarks like Nifty 50, Sensex, Nifty 100, etc. So it becomes very important question to ask, why should I invest in an active mutual fund and why should I pay a 2% on an average fee for a regular plan, or let's say 70 basis point to 100 basis point of cost for a direct plan, when the fund manager is not able to generate alpha, which means he's not able to outperform the market? And why should I basically be exposed to the fund manager risk? As you all know that different fund managers perform in a different market cycle. Why should I be exposed to that risk? And that is where the passive products come into play. Passive products provide you exposure to an underlying index by investing in the underlying constituents of the index. So for example, a Nifty 50 ETF will invest in all the 50 stocks in the similar proportion as they are present in a Nifty 50 index. So the objective is to provide you the returns which are associated with Nifty 50 index. And this passive products do at a very low cost because there's no fund management team required and there's no lot of data intensive work required, which obviously increases the cost. All those things are not required for passive funds. So typically passive funds are at a very low cost. A Nifty 50 ETF on an average is available in the market at just 0.08%. Now, these passive products can be of several types. In India, as of now, there are around 100 ETFs. And a passive product can be launched on any index. If you're talking about globally, there are thousands of funds. In fact, the current AUM of ETF products globally is more than $7 trillion. If you're talking about India, it's more than 2.8 lakh crores. So, and the reason being is that you can launch a passive product based on any index, and this product will be relevant to a typical investor if it aligns with his or her investment objective. So for example, a Nifty 50 ETF provides exposure to the top 50 large cap stocks which are listed on National Stock Exchange, whereas a mid-cap ETF will provide exposure to the mid-cap stocks. Now, these are the example of broad-based ETFs. There are also sector-based ETF like Nifty Bank or Nifty IT. There can be a theme-based ETF also, for example, a consumer theme or a manufacturing theme-based ETF. When we are talking about globally, since globally there are so many attractive themes which are happening, there can be a artificial intelligence based ETF, there can be a cloud computing based ETF, etc. ETF can also be based on different asset classes like gold, like GSEC, like corporate bonds, etc. And ETF can also be based on a certain strategy. For example, globally and even in India right now, there are several smart beta ETF which invest based on a certain strategy. So for example, you can have a value style based portfolio which can be launched based on an ETF vehicle. There can be a low volatility ETF. There can be a quality companies based ETF, which can be put in a method, anything which can be constructed in a rule based manner and is replicable, an ETF or an index funds can be lodged on that. And that is what adds to the attractiveness of passive products, that the underlying portfolio and the product is so rule based and so transparent that you know all the time whether the concerned portfolio is aligned with my investment objective and what sort of exposure I am taking. Now, there's one very important question which people ask at all times, that what is the difference between index funds and exchange traded funds? So differences are several. ETF can be bought and sold based on intraday pricing levels, just like stocks. If the market is down by 1%, let's say Nifty 50 is down by 1% at 12 noon, you can buy a Nifty 50 ETF at 1% lower price. This you cannot do with index funds, which works like a normal mutual fund. You can only buy and sell index funds just based on a day close NAV, unlike ETF, which you can buy on intraday pricing level. Also, as the name suggests, ETF can be bought or sold on exchange, whereas index funds can be bought or sold just like a normal mutual fund with an AMC through distributors, through brokers, etc., but with an AMC. And also, typically, the tracking error, which is how well the fund is tracking the performance of underlying index, is better for ETF than for the index funds, because ETF as a vehicle deploys money in a basket size which is always proportional to the underlying constituent weights. Whereas in index funds, you can, since you're going to the AMC, the cash is typically not deployed in the basket size. And while the fund manager tries to ensure that portfolio is as close to the underlying index as possible, it is typically not the case when you compare an index fund versus an ETF. So typically, your tracking error is on the higher side. Also, the expense ratio of the ETF is lower than the index fund. As I mentioned, that expense ratio of an ETF is around 8 basis points for Nifty 50 ETFs right now. For index funds, you have both direct option and the regular option, and the TER for both direct and regular is typically on the higher side than the ETF. So these are the major differences between the ETFs and the index fund. See, to put it simply, the vehicles are different. The investment objectives are same, that both the products are providing exposure to the underlying index, but way these vehicles are run is different. ETF is an exchange traded fund which can be bought and sold on the exchange at intraday market levels, whereas index funds can only be bought and sold based on day close NAV, and they typically have a higher expense ratio and they typically have a higher tracking error compared to an ETF. Now, lastly, one thing which we wanted to talk about is the asset allocation on how should you approach investing in ETFs. So basically, there are no single answer to it. One, the way people approach ETF investment or a passive product investment is to first decide whether you are looking for an ETF from a core allocation point of view or a tactical allocation or a satellite allocation point of view. What do I mean by that? So for example, if you are investing in a large cap category, and there, if you are analyzing a Nifty 50 or a Sensex or a Nifty Next 50 ETF, this is a segment which has become very efficient in nature, and fund managers are finding increasingly difficult to outperform the benchmark. In these sort of categories, you can ideally go up to 20 to 30% in ETFs. For example, if you're investing 100 rupees in a large cap category, 20 to 30 rupees can be invested in these low cost ETF like Nifty 50 ETF or a Sensex ETF. What will happen if you do that is your overall cost of your portfolio in terms of TER will reduce, the fund manager risk of your portfolio will reduce, and at all times there will be a portion of your portfolio which will give you returns, which is replicating the market returns. So that is the core allocation. So core allocation, if you're doing, let's say, in a large cap segment, almost 20 to 30% of your portfolio can be based on ETF, and this can obviously increase further. There's no, it can go up to, let's say, even 40% or 50%. But let's say if you're talking about a tactical allocation or a short-term allocation, let's say if you feel that BFSI or banking sector is very undervalued right now, then you can take a very focused and known exposure on that front using a Nifty Bank ETF. Or similarly, if you feel an IT sector is very appealing right now, you can take a very low cost exposure in IT sector using Nifty IT ETF. Or if you feel that value is going to be something which is going to work in next 1 year, you can take an exposure in value-based portfolio of companies which have low PE, low PB, etc. through a value-based ETF. So it depends whether you want to take when to do a core allocation or if you want to do a tactical allocation. Core allocation in categories like large cap, you can go up to 20-30% or even more if you are by investing in Nifty 50, Sensex, or a Nifty Next 50 ETF. And if you're talking about tactical allocation, it depends on the kind of call you are making on the markets, and you can take that sort of exposure through ETFs also. Obviously, you can take it through mutual funds, but here you can take exposure through ETFs also if there are ETFs which are providing you the such exposure. So there are multiple ways to look into ETFs. Just to summarize from a portfolio allocation point of view, one is core allocation, where you're looking at broad-based products. Second is tactical allocation. We are looking from a sectoral or a theme point of view. Thirdly, if you want to diversify across multiple asset classes, you can look at gold ETF, you can look at debt ETF and get a very low cost exposure even in other asset classes, right? So ultimately, your allocation in ETFs will first of all depend on your risk profile, on which asset classes you want to take exposure in. And second of all, will depend whether you're investing from a long-term point of view as a core allocation, or you're investing from a short-term point of view as a tactical allocation. So that's it from me. We have talked about ETFs in general, which ETFs are available in India. We've talked about what is passive investing, the difference between index funds and ETF, and how should you approach portfolio allocation using ETFs. I hope this video was helpful. We'll be coming out with more interesting videos on ETFs. But that's it from me today. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.